Hi Moss 4472 team. In this video, I am going to take you through Chapter 3, Risk Management and Internal Controls. In the previous chapter, we defined risks and talked about the various types of risks that organizations face. While in this chapter, we are going to move forward and look at ways that organizations can mitigate risk, particularly through risk management and the development of a strong internal controls environment. Once you complete this chapter, you should be able to accomplish the following learning objectives. In particular, you should be able to distinguish among the three functions of internal controls. You should be able to characterize controls by their location and implementation method. Explain the three lines of defense to ensure effectiveness of internal controls. And lastly, describe the importance of frameworks in an internal control environment. As we learned in the last chapter, an organization has three main strategies of handling risk. They can either accept the risk that they are facing, they can mitigate the risk through implementing various internal controls that decrease the risk, they can avoid the risks, or alternatively, they can transfer the risks to somebody else. Out of the four risk responses we discussed in the last slide, the most common internal control response is risk mitigation. Risk mitigation involves applying internal controls to business processes to reduce risk exposure. In most situations, you're not able to completely eliminate the risk, but you are able to reduce the exposure a business has to risk. A company can take on risks and create a competitive advantage of its business while still carefully considering, calculating, and reducing risks. So organizations may take risk and still do well. Let's discuss what internal controls are. And in this chapter, we define internal controls as a process that specifically mitigates risks to the company's financial information. An adequate internal control process creates assurance that, first of all, accounting information is reliable, complete, and valid, and this includes security, privacy, and the integrity of the accounting information system. Controls also ensure that operations are effective and efficient, and the business is complying to all the necessary laws and regulation. Management mitigates the risk of poor quality information by implementing internal controls over business processes, and these controls can also be inputted directly into our accounting information system. The goals of internal controls are to accomplish the following: to create quality information that can be relied on by all the key stakeholders. And by having quality information, we can lessen the risk of financial misstatements. And we can also prevent fraud because any weaknesses can be assessed and addressed. And not only weaknesses can be assessed, but the organization can identify any potential financial issues that it may encounter. Internal controls also safeguard assets from theft and waste. They can also increase operational efficiencies. They can measure business goals and objectives. They can ensure compliance with applicable laws and regulations and provide investors with reassurance that everything is sound and there is integrity within the financial statements, and they offer an accurate representation of what is actually occurring within the organization. We need to discuss internal controls because regulators, especially of US companies, mandate internal controls for specific types of organizations, such as public organizations. However, internal controls don't have to be required for organizations to adopt them, and there are many organizations that adopt internal controls voluntarily because they realize that there are many benefits of having these controls. Internal controls provide reasonable assurance by mitigating risk to an acceptable level. An internal controls process implements individual control activities, and controls are mechanisms such as rules, policies, procedures that make up a process. After applying controls, companies compare actual residual risk to their target residual risk to determine if further risk mitigation is necessary. So controls are there to decrease risk to a tolerable level for an organization, and if they find that their risk is still too high, they will need to implement additional controls, and controls are customized to a company's unique risks and risk appetite. So although there are control guidelines, the types of controls that organizations adopt really depend on who the organization is, what their strategy is, and what their risk appetite is. In this chapter, we are going to look at many different categories of controls. One way to categorize controls is based on their functions. And there are three types of internal control function. There are preventative controls, detective controls, and corrective controls, and each control has a separate purpose. Let's start with preventative controls. These controls prevent problems from actually occurring. So they stop errors, they stop fraud before it happens. And one of the most common preventative control is policy and procedure documentation. And this type of documentation is effective because it outlines what is appropriate and what is inappropriate, and it highlights the expectations to all the key stakeholders within the organization. Another very common preventative control used by almost all organizations is called segregation of duties. I'm sure you have heard about this in your audit class, but what segregation of duties does is that it lessens the risk of error and fraud by ensuring different employees are responsible for different parts of a business activity. So you have one employee authorizing transaction, another employee receiving those and recording those transactions, and another one having physical custody of the goods. And the reason segregation of duty is effective is that it is much easier for a single party to commit fraud if they are responsible for all these activities versus for multiple employees to collude and perpetrate fraud. And these types of controls can be programmed directly into an accounting information system. For example, you can have different user access for different employee roles. So the employee who is in purchasing can only authorize purchase orders, whereas an accounting employee records these transactions, and shipping or receipts employee has custody of the goods once they are received. Then we have detective controls, and these controls alert management to an issue once it has occurred. They don't prevent the issue, but they do send out a signal that something is wrong and needs to be addressed. These controls monitor business processes to identify problems like fraud risk, quality control, and legal compliance. An excellent example of a detective control is any type of reconciliation. For example, many businesses that work with cash will have a cashier tally up cash receipts, so the actual cash within the cash register versus what the cash sales were to ensure that no money was lost or stolen. Inventory counts are another example of a detective control because they verify the inventory number with what is actually in the warehouse. Lastly, there are corrective controls, and these controls change undesirable outcomes and occur after the potential outcome of a risk has become reality. So these controls are after the fact. For example, a fraud has occurred, and these controls will look at how to correct that fraud. These controls are often used as a backup plan in the event of the failure of the preventative and detective controls, and they include items such as disciplinary actions, report, software patches, and policy updates. So if a fraud perpetrator is caught, then the organization will ensure that they use all their power to prosecute them, to set an example to all employees that fraud will not be tolerated. Please remember that risks can never be fully eliminated. They can only be mitigated, but even the strongest control system has some weaknesses. One weakness that most control systems are susceptible to is referred to as management override. And management overrides occur when internal control activities don't work because management isn't following policy or procedure. So in these situations, management knows what the protocol is, but they choose to ignore it. And because oftentimes management is in a position of power, if employees are instructed to do something that they know is wrong, they will do it because of fear of repercussions. The AICPA describes management override as the Achilles heel of fraud prevention for this very reason. Additionally, controls don't work if two or more people collude to override the control together. And collusion then is just two or more people working together to circumvent controls. As we talked about in a previous slide, one common control that organizations use is the segregation of duties. But if these separate individuals who are in charge of parts of the process decide to work together to carry out a fraud, it is much more difficult to catch them and prevent this fraud because these employees are conspiring or colluding against the organization. When it comes to management's responsibilities for business processes and internal controls, management override and collusion are major concerns. And controls need to be designed by taking these behaviors into account. So the possibility of these behaviors occurring should always be considered. And when auditors perform audits, they always take into account account the possibility of management override or collusion. Now we are going to look at the time-based model of controls. Companies use controls with preventive, detective, and corrective functionality to create an effective control environment. And the time-based model of controls measures the residual risk for technology attacks by comparing the relationship of these three control functions. And an organization's control system is considered effective when preventative time it takes an intruder to break through preventative controls is greater than the detective time it takes to detect the intruder is there, and the corrective time it takes to respond and correct the attack. So the preventative time should always be greater than your detective plus corrective time. Another way that we can categorize or classify controls is by where they exist in a business process. And there are three main locations for controls. We have physical controls, then we have IT general controls, and IT application controls. A physical control is usually the most straightforward type of internal control, as it is tangible and governs individuals and their activities, while the other controls are integrated into the information system. Here is a visual representation of these types of controls. We have physical controls that govern human activity, and these types of controls include a business continuity plan that governs how people and equipment will respond to the occurrence of a disruptive event like a natural disaster or a global pandemic. Then we have IT controls. First, we have the IT general controls that govern the entire IT environment within an organization. And these controls include password policies that require users to create new passwords to log into the corporate network every 90 days, or passwords that have certain characteristic requirements such as the length and the rules governing which characters should be there, some alphanumerical special symbols, etc. Then we have IT application controls, and these controls only govern specific applications such as software. So these are like system rules that enforce segregation of duty among users in a specific software or a particular system, such as the general ledger. So different users will have different access to the general ledger, and this would be considered an application, IT application control. Let's dive in further into IT general controls. IT general controls, or ITGCs, apply to the entire operation of the full system and its environment. All corporate applications like email, web browsers, timekeeping software, benefit management systems, and more are subject to the IT general controls. The technology infrastructure of a company is essential to maintaining its operations, so these controls are very important. And these controls target specific risk statements about the organization. And when it comes to ITGC controls, it is easier to mitigate risk with these controls when risk statements clearly define unique technology risks. So you need to be very specific with these risk statements to ensure that these controls are created to address those specific risks. Next, we have application controls. And so you know, applications are software that capture and record accounting business events for the purpose of this text. And an accounting information system is an application in and of itself. An application control is then a control that only applies to that specific application. It doesn't apply to the general IT environment. And application controls in an AIS can be called transaction controls because they relate to accounting transaction processing. Another way that we can classify controls is looking at how they're implemented. And there are two main methods of implementing controls. The first are manual controls, and these controls are used when human judgment and physical interaction are required. So these controls are really governed by people, and as a result, they are subject to human error or intentional manipulation and override. They are unavoidable when it comes to physical inventory and documentation review. So most organizations will have some types of manual controls, and auditors during their audit frequently focus on manual controls because they are a risk area. In contrast, we also have automated controls. And automated controls use technology to implement control activities. As a result, they are far more consistent and reliable than manual controls because they are not susceptible to either human error, judgment, or override. And many controls exist that are a mixture of both automated and manual components. So they're not mutually exclusive. Controls can exist that have elements of both manual and automated components. Now let's look at some examples of manual and automated controls. Just to review, manual controls require human judgment and interaction, and some examples of manual controls include physical inventory counts, supervisor review and write-off, employees performing bank reconciliations, various policies and procedures, employee training, and management reviewing weekly exemption reports. In contrast, as we mentioned, automated controls use technology to implement a control activity. So examples of these types of automated controls include system performed three-way matches, system user role privileges and limitations, continuous monitoring and data analytics, calculations that are directly embedded into a spreadsheet, and system limitations that determine which approvals are required based on transaction amounts. Continuous monitoring. Continuous monitoring technology is used by internal auditors as detective controls. It uses rule-based programming to monitor a business's data for red flags of risks. Continuous monitoring is programmed to monitor key performance indicators or KPIs, so areas and factors that the business knows are important. Automated risk management procedures allows management to identify and eliminate potential problems as soon as the red flags appear. For example, a KPI most organizations have is total sales. If sales are going down, then management can address what could be the potential reasons for this. And continuous monitoring deals with multiple aspects of our accounting information system. For example, it uses data stored in the AIS system for analysis, and this requires the data to be accurate. and it is often a separate information system that creates its own risk. And continuous monitoring is a type of internal control that is used in addition to other internal controls. So it's not a substitute for other internal controls. It is used in conjunction with other internal controls. Control categorization. So as we have discussed in the previous slides, a control is categorized by its function, its location in the business process, and how it is implemented. This is a great chart or graphic that summarizes all these categorizations. So our functions, remember, are preventative, detective, and corrective. The location of the control can either be physical, it can be within the general IT infrastructure, or within a specific IT application. And then we look at how controls are implemented. They can be implemented manually through people, or they can be automated and programmed in advance into various systems and applications. Now that we know what internal controls are, we can discuss how to assess them. Manual controls are subject to human error or manipulation, while automated controls can have technological malfunctions. That's why we always say that risk can't be eliminated. It can only be decreased or mitigated. Companies must continuously assess both the overall internal control environment and individual controls to determine if they are functioning properly and addressing risk appropriately. Assessment can be performed either internally or externally by management, internal auditors, or external auditors. These business functions can be divided into 3 lines of defense based on their involvement in combating risk to protect the organization. So management is both the first line and the second line of defense. So as a first line of defense, management has ownership and responsibility of enforcing mitigating measures to prevent identified risk from occurring. They are responsible for developing, assessing, implementing, and managing business procedures. As a second line of defense, management creates risk management and compliance, and they're responsible for identifying and assessing organizational risks. The internal audit function is a third line of defense because they are independent from the rest of the organization. So they don't have a stake in the organization. They're supposed to be kind of an unbiased third party. And they report both to management and the board of directors. So if they see issues with management, for example, management override, they have the ability to report directly to the audit committee, and their responsibility is to test internal controls to see if there are any weaknesses or deficiencies. So as I mentioned in the last slide, management is really both the first and second line of defense. Management includes the first line of defense in business operations and second line of defense in compliance and enterprise risk management teams. Management control business processes and mitigate risk through both preventative, detective, and corrective actions. The responsibility for processes and controls rests solely with management, and the internal audit team provides a complementary objective assessment. So remember, management is responsible for controls. It's not the internal audit team that's responsible. And external auditors are not part of the 3 lines of defense of an organization because they are outside third parties who provide external assurance. They are not in charge of the risk environment. This is a great graphic within your textbook that summarizes the 3 lines model that we discussed in the previous slide. We have all the stakeholders involved. We have the governing bodies. We have management. We have the internal audit team. And we have our external assurance providers. So here we see that the governing body is responsible for oversight of the organization, and they're accountable to stakeholders. And their role are integrity, leadership, and transparency. They create rules that management must abide by, and in turn, management needs to report to them. Management is responsible for many actions, including achieving organizational objectives and managing risk. In their first line of defense, they provide services and products to customers and manage risk, while in their second line of defense, they provide expertise, support, monitoring, and challenge on risk-related matters. Management interacts with the internal audit team, who then also interacts with the governing body. The governing body provides the internal audit team rules, and the internal audit team provides reporting back to the governing body. The internal audit is the third line of defense because they are independent and can provide objective assurance and advice related to the achievement of the organization's objectives and any risks that they may encounter. And outside of this, we have our external assurance providers, such as our Big Four firms that do financial statement audits. Now let's look at the maturity model of internal controls. And this model displays how far along a company is on its journey to reach the ideal state by comparing its current state to a predetermined set of best practices. We'll look at what these best practices are in a moment. And companies use the maturity model to judge their current performance and create a plan for continuous improvement. By setting best practices to design and select a maturity model, organizations gain a guide for envisioning the future, both the desired state and the development needed to get there, benchmark for the organization to use in comparing its processes both internally and externally, insights into improvement path from an immature model to a mature model, and discipline models that are easy for management to understand and implement. Here we see the different phases of maturity. When organizations begin, they're very limited, and all this means that processes are very informal. There are ad hoc controls. Management is reactive to situations as they occur. And the organization has a reliance on key individuals to function and keep going. As the organization matures, it reaches the informal stage. In this stage, there might be some defined processes. There may also be some defined controls, but there is still a lack of documentation, and there are only primarily manual controls. There might be inconsistencies in how things are done, and the reliance on key individuals exists. As the organization matures further, they get into the formal phase of maturity. In this stage, the organization has clearly defined processes. They have clearly defined controls. There is formal documentation. The organization has a mix of both manual and automated controls, and there is no longer a reliance on key individuals. The optimal state or the optimized organization occurs when there is an enterprise risk management, when there are enterprise-wide control environments, there is a top-down proactive approach to the business, there are clearly defined processes, there is clearly defined controls, there are formal documentation, there's clear communication throughout the organization, both top-down and between departments. There are more automated than manual controls, and the internal audit team exists and it provides the organization value. Now let's talk about the internal audit as the third line of defense. Internal audit adds value to a business by providing assurance, insight, and objectivity to the company. Some organizations outsource their internal audit departments because they are a specialized skill set and they find that having specialists from other organizations adds value. In addition, outsourcing internal audit can be effective because it ensures independence, because those individuals are contractors rather than employees of that company. Internal auditors must remain independent of all business functions that they audit. They can't have any stake or influence over the outcome of business processes that they are auditing to ensure that they are objective. So independence ensures objectivity, and internal auditors provide insights into company policies, procedures, processes, controls, and culture. There are three main ways that internal audit teams contribute to an organization. They provide assurance and ensure that organizations are operating in accordance with the management's plan. They provide insight by discovering improvements for policies, procedures, controls, and risk management. They also provide objectivity by assessing the company from an independent consulting point of view. As mentioned in the previous slides, the internal audit department adds value to organizations, and many organizations that are exempt from SOX still choose to establish an internal audit department because of the following reasons. The audit department assesses whether controls are well designed or if they need to be redesigned. They determine if controls are functioning as designed. So are the processes and procedures functioning the way that they were envisioned? They provide objective insight because of their independence. So they provide a unique perspective to management and the organization as a whole. They ensure that organizations are complying with regulations, and they have the ability to identify opportunities for strategic improvements. And oftentimes this occurs because they have a different view, and often it's a bird's eye view, so they don't get lost in the trees. They can see the whole forest and where the company is and where they may or should be going. Control frameworks are used by organizations to ensure an effective control environment. the rise of control frameworks are attributed to Sarbanes-Oxley. This law was established in the US after many financial scandals. I don't know how many of you have heard about Arthur Andersen, which was a Big Five accounting firm that ceased to exist. And there were scandals such as Enron and WorldCom, and it had a detrimental impact on the accounting profession and our professional integrity because there was a lot of fraud and financial statement misreporting. So this law was brought into place to protect investors from fraud and other risks by improving the reliability and accuracy of financial statements. SOX focuses on internal control structure of an organization. It ensures that there is clear responsibility if a control failure occurs, and these control failures are always attributed to management. So management is responsible for the control environment, and they impose some serious criminal penalties to deter fraud from occurring. SOX compliance is required for a certain subset of organizations. For example, publicly traded US companies and their subsidiaries, foreign companies that are publicly traded and do business in the US, private companies planning their initial public offering or IPS in America, and accounting firms that perform audits of the above SOX regulated companies. Now let's look at some of the most significant SOX requirements when it comes to the roles and responsibilities of CEOs and CFOs. They're responsible for the accuracy and documentation of financial statements. They need to ensure that financial statements are reviewed and signed off by management, so CEOs, CFOs. They're responsible for the overall internal control structure reports provided to the Securities and Exchange Commissions and informing external auditors about any significant internal control issues or fraud. SOX also requires an internal control report that is included in the financial statements. And in this report, it states that management is responsible for implementing and maintaining an adequate system of internal control. And it contains an assessment of the effectiveness of the system of internal controls. So it's supposed to declare that the control system is effective. Continuing on, some other requirements pertain to an external audit. And this external audit is supposed to evaluate management's assessment of effectiveness of the system of internal controls and provides an audit opinion on management's report. It's supposed to include disclosure of any significant internal control deficiencies, which are controls that are not operating correctly, hence the term deficiency. And it includes disclosure of instances where the internal control environment is not in compliance in SOX. And SOX also has some formal data security policies, and these policies need to be communicated and enforced throughout the company and ensure protection of all financial data in storage and use. To be effective, an organization's internal control framework must be free from any bias. It should provide consistent measurements of internal controls, be complete enough to include any relevant factor that may alter someone's opinion about the internal controls of the organization, and have relevance to the evaluation of internal controls over financial reporting. A very popular internal control framework is the COSO Internal Control Integrated Framework, and most companies use this COSO framework for internal controls. It's very popular, and this is a control-based approach to risk management and is regarded as the authoritative guidance on internal controls and SOX compliance. It defines internal controls and gives the criteria for developing, implementing, and monitoring an effective control system. The internal control integrated framework consists of 2 parts and a visualized model. So the 2 parts are the control objectives and the components and related principles, and our visualized model is the COSO cube. Some areas that SOX cover include cybersecurity protection against fraud and threats, handling the advanced complexities of business, meeting high expectations of oversight from leadership, operating in global markets, performing robust and detailed risk assessments, adhering to complex requirements of regulations, laws, and standards, improving efficiencies in operations, providing increased reliability of financial reporting, adapting and reacting to evolving technologies, providing cost savings, and improving the effectiveness of internal controls. Now let's talk about the 5 key control components that make up the COSO control framework. At the top, we have the control environment, and think of this as the foundation for other components. It includes the attitude of management concerning both integrity and ethical behavior. And SOX requires routine tests of how internal controls are monitored and an annual control review by external auditors. Next, we have risk assessment, and this requires management to continuously identify, categorize, prioritize both internal and external risks. And risk assessments also need to identify fraud potential and changes that could impact the functionality of internal controls. Once we have our risk assessment, then we look at our various control activities, and this component consists of the policies and procedures that address risk and support the achievement of companies' objectives. Then we have information and communication, and this component consists both of internal and external communication, including financial reports, policies, and procedures. Lastly, we have the monitoring component, and this requires assessment of internal controls and determines whether or not changes need to be made based on how these controls are functioning. Management needs to monitor business processes with detective controls to ensure that the controls are working appropriately. Risk responses. COSO shows how parts of an effective control systems are related in the COSO cube. So this is the visualization. The 3 objectives are at the top, and they make up the columns of the cube. So our objectives are operation, reporting, and compliance. The rows relate to the 5 interrelated control components. So we have our control environment, our risk assessment, our control activities, our information and communication and monitoring, And our third dimension relates to an organization's structure, starting from the entity level or the organization as a whole, and drilling all the way down to individual job functions. In recent years, the COSO control framework got reorganized into a more comprehensive view. So this is known as the COSO Enterprise Risk Management Framework. So COSO updated its framework to reflect the importance of risk management in strategic planning, and it encourages organizations to incorporate risk management throughout their departments and functions. The ERM framework is a set of 5 interrelated components that highlight the importance of risk in creating strategies and driving performance. Our first component is governance and culture, and this includes setting a company's tone and establishing various oversight responsibilities for the enterprise risk management. Next, we have our strategy and objectives, and this includes engaging in strategic planning that combines strategy, risk management, and objective setting to determine the risk appetite and to align it with business objectives. So now risk identification and mitigation is part of strategic planning. Then we have performance, and this includes assessing and identifying risks and responding to risks at a portfolio level. And these reports provide results to key stakeholders. Then we have our review and revision, and this includes reviewing performance to consider how well ERM is functioning and identifying the various necessary revisions. Lastly, we have information, communication, and reporting, and this looks at continually obtaining and sharing information from both internal and external sources and flowing this information up, down, and across companies. The main advantages of the ERM framework are that they aim to improve the risk management processes by addressing more than just internal control. They want to make risk management a part of the organization's strategy and focus. They embed risk management throughout the organization as a prime responsibility of both management and the board of directors. This framework is much more comprehensive than the previous internal control integrated framework because it focuses on all types of risks and not just internal controls. And it applies to all functions across all levels of an organization and is present throughout the strategic and strategy formation. That is it for this chapter. Please advise me if you have any questions. I look forward to seeing you in class next week. Bye.